We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alfonso Peccatiello, author of the Macro Compass Substack. How are you today, Alf?
Hey, Tom, I'm doing good and very well done with my surname. It normally gets butchered, but you did very well.
Thank you. I always try to make it a bit of a challenge to make sure that I get it as right as possible. So, being the author of the Macro Compass Substack, you have a bit more of a macro view, not only of the US, but of the world here. So, going through some of your articles, I found it really interesting how you've really pulled out the biggest themes that are really affecting not only growth, but economics as a whole here. So why don't we start by talking about what the actual main drivers of economic growth are?
Yeah, I think it's a great question, Tom. So that's also what I asked myself when I started my career in finance. So before starting to produce the Macro Compass, I was managing a $20 billion portfolio. And, you get a lot into the weeds of what's happening today in markets because everybody wants to try and deliver performance today. But I asked myself, what is actually the driver of long-term growth? I mean, what are we doing here? So I started my learning journey, basically. And that led me to understand that long-term real economic growth is basically driven by two things. It's really very simple. It's population growth or demographics and how productive this labor force is and the capital that we produce is at the end of the day. So it's productivity and labor force growth. So let's talk about labor force growth. That's basically a byproduct of demographics, right, Tom? I mean, at the end of the day, if the population is growing, and it means that there are more births than deaths, and it also means that there is a larger share of working age population. And year after year, it keeps on growing. And that happens when there is a birth boom, right? I mean, after Second World War, it's a typical example where there was peace for a few decades, and that led to birth rates increasing and then standards of living increasing. And then 20, 30 years later, in the 80s, we found ourselves with a largely growing labor force. And if the labor force grows, obviously, assuming constant productivity, still the economic output goes up in the long term. Now, that's one part. And then the second part is how productive this labor force is, and then the total factor productivity of the economy, including the productivity of capital. There is a study out that I analyzed at the Macro Compass on the productivity of the United Kingdom over the last 250 years. And you can see in this article called The Macro Endgame, actually drops in basically this productivity trend being linearly dropping year after year, which it doesn't mean we are becoming less productive. It means we are still growing in terms of productivity, but at a slower pace that we used to grow our productivity in the 40s, in the 50s, and in the 60s. And that's because the industrial revolution that we had, basically, that led this productivity to become increasingly quicker over those years, has actually at some point stalled. And technology, which has come in, has increased productivity hugely for a certain portion of the economy, while there is a large share of the economy that is still not, let's say, taking on the benefits of this increased productivity. So at an aggregate level, total factor productivity is still growing year after year, but it's growing at a relatively stagnant pace. And demographics, well, that has dropped by a lot.
Mm-hmm. So it's really just the actual growth rate that's falling and not necessarily, I was going to say, because, you would think that productivity falling is a bit of a counterintuitive idea, considering that with the Industrial Revolution, that has only served to hopefully increase productivity. And with the advent of computers and everything, you would think that would help a lot. And I was thinking, the advent of smartphones, maybe you could point to that as a waste of productivity, right?
Yeah, from a certain extent, yes. And so the point is that the big picture is always important and productivity is rising, but the pace of this growth has actually decelerated a bit. And on demographics, well, that's even worse, because if you look at the labor force had been growing and increasingly faster throughout the 80s. But after the 80s, the birth rate booms actually started dropping, So we started basically having less kids per couple. Mm-hmm. And at the same time, the population started aging very rapidly. And so if you look at the amount of people that produce for the real economy, so the labor force itself, and if you look at the growth of this labor force, it actually started plateauing. And in some places, it drops year after year. So if you have 100 people working, let's say in China today, you will have 95 people that contribute to working age population in China in 10 years. And then you will have 90 people. And then you quickly understand, Tom, that if you extrapolate this trend, then you'll have less people producing, then growth rates are over the very long term trend down, and pretty aggressively so, which is what we actually have been experiencing. I mean, in the 80s, a normal growth rate was supposed to be in real terms, something like 4 to 5%. Mm-hmm. And today, unless we borrow, which is, by the way, what we have been doing, and we can talk about that later, if you exclude all the leverage we have been applying to try and grow a bit more, the structural growth we're able to produce is around 1% in real terms. And that's the result of these long-term factors actually coming down.
Yeah, that's exactly where I wanted to go next with you, Alf, is what has really taken up the slack as we've seen growth of productivity fall?
Yeah, I mean, it's credit, it's leverage, it's debt. So that sounds very scary, but that's how the system works. Basically, after 1971, where the gold standard was scrapped, the system moved back to something which is called a fully elastic credit system, which means that you can basically increase leverage, increase credit into the system, and you have no hard quantity, hard asset that is backing this newly created money. There is an implicit peg into that because people will always appreciate what it's a hard, valuable asset. And this asset will go up in price when priced in this fiat currency, but there is no hard limitation, which was in the gold standard. Now it's not there anymore. So during the gold standard or any other system that pegs credit creation to a hard asset, you basically can convert at a fixed price your newly created fiat currency to the hard asset, back at a fixed price. Now, if you eliminate this, then obviously there is an inherent incentive to create new credit to basically boost cyclical growth. And there is not even the problem of having to respect this hard peg. Mm-hmm. Now, in the 80s, politicians started to understand that actually the long-term drivers of growth had peaked. And they saw that in demographics first, and then productivity came down a bit during the 90s and 2000s and up until today. So it's politically non-acceptable, Tom, to have a long-term growth of 1%. I mean, that just doesn't feel appealing for society to hear, right? So what we do then is we overlay cyclical growth on top of this very poor structural trend. We basically borrow it from the future. Mm-hmm. So when we expand credit, when you go to a bank, Tom, and you get a loan, what happens is that the bank simply credits your account. The entire banking system expands. It expands. The money is created from commercial banks out of thin air. They credit your bank account. You all of a sudden have new money. And with this new money, you can go and do what you wanted to do with the loan. You want to buy a car, you want to buy a house, whatever. When you do that, you basically buy an asset that already exists, right? And then who sold you this asset will find itself, instead of the asset, a new deposit. I mean, it takes the money, deposits it in a bank account, and the entire banking system balance sheet has gone up. So there is now more credit, more money into the system than what it was before. And you don't need existing deposits to do that. Commercial banks can just decide to extend their balance sheet if they trust Tom to repay back this debt. And now Tom all of a sudden feels more wealthy because he has newly created credit on his bank account. He can now afford living a wealth illusion that before he couldn't afford, and he can now buy a house of $1 million, even though he doesn't have $1 million on his bank account, mm-hmm. because the bank just credited this money on his bank account. Now, and this is leverage. This is credit. We borrow. We basically lever up. There is an obvious problem with that, is that we need to service this increasing amount of leverage, right?
So when we think about this on a more, let's say, central bank level, Alf, we see the headlines that the Fed is starting to tighten. So the QE program has pumped billions and billions of dollars per month into the system. Do you think that QE has inflated asset prices?
Yes, the answer is yes, but I want to clarify a few things before we get there. Okay. There are two systems and two forms of money, and people mix them up all the time. Even in professional industry, that happens a lot of time, guys. I can't stress it out. I'll try to clarify. There are two systems, like parallel, non-communicating systems of money. One is what we call reserves, bank reserves. And the other one is the real economy, inflationary forms of money. Now, what QE does is it expands the Federal Reserve balance sheet or any central bank balance sheet. So the central bank can just expand their balance sheet out of thin air. On the liability side, they create these new reserves, they take those and they buy assets from financial markets, bonds. Most of the times they buy bonds with it, right? Mm-hmm. So they expand the asset side, more bonds, they expand the liability side, more reserves. The liability side of the Fed is then reflected into the asset side of the commercial banking system. So the commercial banking system before had some bonds because, banks buy bonds for a bunch of reasons. And now after QE, they have less bonds and they have more of these reserves that the Federal Reserve have created. The bonds are taken away from the system and they are exchanged with reserves. It's an exchange, it's a swap. There are the commercial bank balance sheet didn't increase. It just changed its composition. Mm-hmm. These newly created reserves, they do never flood the real economy. They are stuck into the interbank system. This is one form of money that you cannot use, Tom, to go and buy bread. You cannot do that. These reserves are used from bank to another bank to settle payments. So Tom buys something from me, and on the background, I bank with JP Morgan, you bank with Bank of America. JP Morgan and Bank of America at the end of the day need to settle payments, right? My payment towards you, another payment A to payment B, and they will settle those with bank reserves. Now they have more of these bank reserves, but they cannot lend them out to the real economy. They can just settle on the background payments that happen in the private sector. Now, so what QE does is it floods these banks with reserves. They have so many of them, way too many of them. Mm-hmm. When you have too much of something that you don't want, because reserves for banks are just for interbank settlement, that's it. They don't make any money on these reserves most of the times. You will try to get rid of those if you're a bank. So you will try to lend them away to another bank. That's the only thing you can do with these reserves, really. Mm-hmm. So when you do that, then basically you will be trying to get rid of them, which means the price of this, of owning these reserves actually will be pretty punitive, which will incentivize banks to try and buy some other assets instead of owning all these reserves. They will say, get away of these reserves, buy me some assets instead that I can actually own according to what regulation says. It's very important. And regulation says, banks, you can own bonds. You cannot buy gold, equities. You can buy bonds. So what banks then do is they say, oh, I have all these reserves. Bonds have been taken away from me because of QE. I want some bonds. Actually, they yield a little bit better than these useless reserves. And so they will go back and buy bonds on top of the Federal Reserve already buying bonds. And once bond yields have gone down, they will move then to corporate bonds, to the next one. So it's still bonds with a little bit of credit spread. Risk is acceptable. The regulator says I can own corporate bonds. I will buy those. And then after that, the equity investor that can also buy corporate bonds will say, look at these corporate bonds. They yield nothing anymore. So then I will move up the risk channel and I will buy some equities now. And that's our second and third round effects. QE ultimately leads to what we call a portfolio rebalancing effect that basically leads to asset prices to become in relative terms more expensive.
That was a great way of explaining that, Alf, because, thinking about it and laying it out is, A, it's difficult to explain, and B, it can be difficult to understand. But I like how you put that of the second and third level effects. As you were explaining that, though, the swap between banks where they have to settle their transactions at the end of the day. Is the reverse repo market, in a way, a replacement for QE?
It's a tricky question. So basically, the reserve repo facility is simply a release valve, effectively. So this is basically the Federal Reserve saying, okay, we inundated the system with excess reserves. Mm-hmm. Now, as I said before, these excess reserves, everybody wants to get rid of them. They don't know what to do with it. So the obvious thing will be to, buy some very short-term bonds with it that don't carry much risk and possibly they yield a little bit better than these reserves. If everybody would do that at the same time, then you would have the yield on these T-bills actually go negative, because there is so much of these reserves chasing the exact same asset, which is T-bills, which is a replacement for short-term exposure to basically overnight cash, that then these yield on T-bills would go negative. And clearly the Federal Reserve does not want nominal yields to be negative. They already have to try and massage the fact that real yields are very negative. Imagine, Tom, if nominal yields would go negative. This would make headlines. This would raise questions. I think it's a bad risk reward for them. So what they thought of was, okay, let's now give basically a facility away where you can park these newly created excess reserves basically and have a facility where you are not penalized too much and you can effectively earn yields that are slightly above zero with it, right? So it's a release valve. You do QE and then the reverse repo facility offers a release valve to avoid that short-term interest rates go negative. So does it fully offset QE? No, it does not, because QE does something else on top of exchanging these reserves for collateral. So collateral are bonds. Sorry for the jargon sometimes. So QE, as I said before, takes bonds away, gives reserve to the system, right? And then the reverse repo is basically the opposite when it comes to exchanging nominals. So I give you 100, you give me 100. But it's not the same when it comes to the risks that are extracted from the market via QE. So a bond basically also basically, if you want to own a bond, you have to take something called duration risk, interest rate risk. So buying a bond, you not only take your cash and exchange it in nominal terms for a bond, but also you take some risk on the risk that interest rates will go up, right? That's called duration risk. What QE does is it removes permanently, effectively, until the central bank sells this bond back to the market, the QT, which normally happens years later. So semi-permanently, it removes this interest rate risk from the market. So the private sector does not need to absorb it anymore. It's the central bank that swallows it completely. Mm-hmm. And the reverse repo, well, it does not do that, because what we are doing is we are lending back this collateral to the market in exchange for these reserves to the market in exchange for treasuries. So we are doing it on a nominal basis, but you are not putting again the interest rate risk into the market, because the day after, Tom, the thing will reverse. So the treasuries will go back to who own them and the reserves will go back to who own them. So it's just a nominal exchange that overnight rebalances a bit the cash versus bond imbalance that QE has created, but the interest rate risk is not thrown back to the market. Those bonds are still on the Federal Reserve balance sheet, and they're not coming back to the private sector unless we do QT in proper size.
Mm-hmm. So, Alf, now with the Federal Reserve announcing that they're going to be tapering QE, we've always heard about the markets going into what's called a taper tantrum. So do you think that rising interest rates are actually going to have a more negative effect on the stock markets than quantitative tightening?
So basically you go policymakers always try to do things step by step to massage them in, because they're interested in keeping the status quo rather than doing something extremely difficult to digest. Mm-hmm. So when I was doing my job, I had the chance to talk to these central bankers, to these prime ministers. And if you talk to them, you immediately realize, Tom, what they want is not to be in the tails of the distribution. They don't want to be the guy that caused an event that is unimaginable. They just want to be in the body of it. Just keep things as they are, keep the status quo, and then try to get reelected. It's literally what they want. So when you reverse this process of pumping new reserves into the system. You remove them from the system. That's a more tricky thing for markets to digest. And this process, which starts with tapering is like basically slowing down the rate of QE, all right? And that is going to end in March. It's been announced. Basically, from March onwards, the Federal Reserve is going to buy 0 bonds each month. They don't do QE anymore. They've tapered it down completely. After that, there is QT. And that's the tricky part. Because one thing is to pump less reserves on an additional basis month by month. The other thing is to remove them from the system completely. That's quantitative tightening. And that's also why markets are a bit more nervous. And so quantitative tightening basically reverses all of what we have said before and removes these reserves from the system. So it gives banks less incentive to go chase after these assets that we talked before, right? Corporate bonds. And then this makes the pension fund want to chase equities. All of that is all in reverse. Nobody wants to chase anything anymore when that happens, right? So you have to be very careful with that. Interestingly, on interest rates, the impact that quantitative tightening has, according to my studies, is that the short term of the interest rate market tends to go up in yields. So basically, the Federal Reserve is hiking interest rates, and on top of that, it's reducing reserves from the system, so that basically, there is less incentive to go and chase immediately all these short-term instruments, so the yields goes up. But the long-term yields, so third-year bond yields, for example, they actually don't move or even come down. That's very counterintuitive. The curve basically flattens. Yields go up at the short term and they go down at the long term, or they stay the same. So yield curve flattens. And that's very scary when the yield curve flattens so much. And second, it's pretty counterintuitive. I mean, people are like, we are doing QT, not QE. So also long-term rates should go up. And they don't, because remember what we said before. The long-term drivers of economic growth, so 30 years down the road effectively, are actually going down. That's demographics and productivity, and QE or QT are not going to change that. So that structural trend remains. And now the Federal Reserve in this cycle is becoming much more restrictive, which possibly even reduces the long-term growth a bit more. So if you have to own bonds for 30 years, now you're even more sure that the final outcome will be so bad that it's in terms of growth and inflation, that you will be sort of okay owning the long-term part of the bond market, while the short-term, not really. Mm-hmm. And so this yield curve flattens and everybody looks at it very carefully because it's such a great predictor of recessions.
Mm-hmm. Alf, it really makes me wonder, when we look at the real yield on bonds versus the nominal yield on bonds, why anybody would want to own a long-term bond?
Yeah. Again, hugely important question. I get that a lot, and I want to try and answer it the right way. The main reason is regulation. And that is a weird one. But in 2000, and since the great financial crisis, so soon after, mm-hmm. the regulators decided that banks needed to own a lot of bonds, a lot of them, by a regulation called liquidity coverage ratio. So basically, the regulator went to the banks and said, guys, you need some liquid stuff on your asset side of the balance sheet, because if something bad happens and a lot of people want to withdraw their deposits all at once, you need to be able to service them. So if you have some bonds, you're going to sell them realistically at a nominal price close to the one you bought, and then you can take this money and basically pay back the deposits to the people coming for a bank run, basically. And you didn't have all these liquid assets on the asset side. You had a bunch of crap on the asset side. You had asset-backed securities, mortgage-backed securities. I mean, we need more liquid stuff. So this regulation basically now still in action forces banks to own 15% approximately of their balance sheet in liquid assets. Now the regulator came and said, do you know what a liquid asset is? It's a bond. It's either a bank reserve or a bond. So, I'm basically telling you, you must buy billions and billions of bonds effectively at any price because regulation says so. Mm-hmm. And the same goes with pension funds, obviously. They have very long-term liabilities, Tom. They need to pay pensions in 30 to 40 years. And these liabilities obviously have an interest rate risk because, if interest rates go down or up, the value today of these liabilities changes when you try to mark them to today's market prices. If the yields move up or down, they actually change in value. And so pension funds buy these long-term bonds to basically hedge this risk. They're like, if I need to pay Tom in 30 years, I don't want the risk that interest rates have gone up or down through the next 30 years. I'm going to buy something on the asset side, again, long-term bonds, to hedge this risk. So as you can see, it has very little to do with economics, really, of buying this stuff yielding below foreseeable inflation rates. It has a lot to do with hedging risks or regulation telling you, I don't care if you like it or not, you have to buy those.
Mm-hmm. So, Alf, when we think about, let's say, the dual mandate of the Fed, right? They have the mandate of price stability and maximum employment. Do you feel that those two things are at odds?
That's a nice one. So I'll tell you what the Fed would say. The Fed would say, we have this very fancy model, which is called NAIRU. It's something called non-accelerating rate of unemployment, basically non-inflationary accelerating rate of unemployment. And it's something you can't observe. They make it up and they say, okay, if unemployment rate is at 4%, there will be a healthy wage pressure into the economy so that, there are very little people unemployed. They can demand higher wages, but not incredibly higher wages. So you'll have these inflation rates going up a bit because purchasing power of people will go up steadily. Let's say wage pressure will be 1 or 2%. So people have this increasing wealth to spend in real terms. And this will drive inflation to be where we want it to be, about 2% a year. So if you ask them, they say, no, what are you talking about? If I achieve maximum employment measured with this NAIRU, let's say 4%, then inflation will turn out to be where I want it to be. So I achieve both. The reality is a bit more complex. Mm-hmm. So before the COVID crisis, unemployment rate in America in 2018, I think after Trump tax cuts, went to 3.5% for a full year. And even if you broaden the definition of unemployment rate and you incorporate part-time people, discouraged workers, all of these guys which are not captured by the unemployment rate, you are at 7%. I mean, even on a broader measure, it doesn't get lower than that. And this was way below what the Federal Reserve, Tom, thought it was their NAIRU. So this could have generated, in their mind, 4%, 5% inflation back then. And in 2018, the highest we got was 2%. Anyway, so which tells you that their model of NAIRU was obviously wrong. So they had underestimated the level of unemployment needed for inflationary pressures to pick up. So I would say that they try to PhD the thing out, but their success so far has been pretty modest in trying to achieve both angles of their mandate. And now they are in a pretty tight spot, in a really tight spot, because they're looking at inflationary pressures at 7% measured by CPI. It's likely to come down a bit, but it's a pretty robust overshoot compared to their mandate. And so what they want to do is to be seen as fighting those pressures. It's also a political incentive, right? I mean, midterms elections are coming in November. So, the real purchasing power of Americans is being shrunk by the fact that inflation rates are above their nominal wages increases. So yeah, in real terms, you lose purchasing power. Biden doesn't want that. So they're skewing more to that side of the mandate, fighting inflation. Mm-hmm. But if they act too hard, what's going to happen is that the borrowing costs for the private sector are going to go up. And if they go up, then this wealth illusion effect by extending more credit, the one we discussed before, it doesn't hold anymore because you can't service your mortgage if it's the mortgage is at 5% instead of 2%. You can't afford anymore a house which is worth $1 million, right? Mm-hmm. So they're in a pretty tight spot here, and they have to maneuver this around. It's going to be very hard.
So, you've mentioned several times, Alf, the political appetite for something. So let's say out of the two options of, let's say, deleveraging the system or kicking the can down the road, does that incentive ultimately just keep making the problem bigger and bigger because politicians keep just wanting to choose the option of kicking the can down the road?
Yes. Could have not summarized it better. So, Tom, the thing is, the system that we have built since basically the 80s, based on more and more leverage, to try and leave a wealth illusion effect where it looks like we are growing much faster than what we can afford growing, given the structural drivers of growth are pretty poor. Mm-hmm. This system is working in brackets according to the establishment, and there is no alternative, really. No politically acceptable alternative. And let me explain. So you have basically two ways to deal with this system. A, it's just, rinse and repeat, kick the can down the road. So you will have times where you will, this increasing leverage will look too much. So you will try and clamp it down a bit. That's where we are now. That's where you will try to make the cost of money a bit more expensive, right? And real borrowing costs for the private sector a bit more expensive. The result of that is undeniably negative, and it will lead you at some point to return to the experiment, because as you do that, people don't borrow anymore that much, and the cyclical growth starts to come down, and the system doesn't hold together anymore. So you'll have to redo an experiment all over again, which is to expand credit and then to lower interest rates to make this new credit accessible for people. That's the kick the can down the road, right? Mm-hmm. And politicians will do that for as long as possible, because the alternative is horrible. The alternative is, there are two alternatives here. One is upfront deleveraging, which means basically you have to wipe out about 50 or 60% of the generational wealth accumulated by two generations that have lived and flourished to this wealth illusion effect. So this is basically house prices having tripled in real terms over the last 20 years. And this is all your 401k accounts having gone through the roof over the last 10 years. You'll have to take all of that and erase that, at least half of that. You'll have to make a huge damage to at least two generations, such that basically the level of leverage in the private and public sector come down and interest rates then naturally come up again, to the point where you can restart basically the whole thing. This is politically unviable. Mm-hmm. I mean, there is no politician that will volunteer for this to happen. And the strongest signal that this will not happen on a voluntary basis is that the pandemic was the perfect setup for politicians to justify such a thing. It's an exogenous event. It's something that just lands on us and that we can't control. So, policymakers could have said, I'm sorry, guys, but, you'll have to go through some deleveraging here. We haven't predicted that. So, yeah, it just happens. Bad luck. And they have decided to do the exact very opposite, Tom. They have said this is a huge exogenous event. It's causing damage. It's causing deleveraging. There are no cash flows. Everything is closed. The economy is over-leveraged. This is looking bad. And they have responded in the strongest possible kick the can down the road way ever. 25% fiscal deficit to GDP cumulative in 2.5 years. This is ridiculous. It's huge, which tells you where their incentive scheme lies. It lies in kicking the can down the road. Mm-hmm. The third option is what I call, in the macro endgame at the Macro Compass, is what I call a monetary reset. And the monetary reset is an event that happens every lifetime, effectively, or even longer than that. It's very difficult to think when will that happen. It generally happens very slowly behind the curtain, but it's basically resetting the system to something that is different than a fully elastic credit system backed by nothing. All right. So we had the gold standard before. People are now talking about the Bitcoin standard or digital assets playing a role in this new monetary system. But this is another tectonic shift, really, that doesn't happen out of will of politicians and policymakers. It happens either through time and then a very strong event like a war, for example. It doesn't happen because policymakers want it to happen. So kick the can down the road is our base case. It has to be, because that's where the incentive schemes lies. We like it or not, we have to deal with it and also invest accordingly, I think, and protect our purchasing power accordingly. And the other events, so the upfront deleveraging or the monetary system reset, are to be considered as tail events that could happen. And so we have to think how to position for that too.
Mm-hmm. So in that vein, Alf, how are you trying to position your portfolio to try and protect it from the trends that you see coming here?
So on a very long-term basis, let's say, I would like to focus on that more because I was an institutional money manager trying to trade the market every day. And then I think it's much more interesting for the audience to zoom back, right? And say, okay, what do I need to do here looking at the next 5 or 10 years? So what I do is, as I said, my base case, Tom, is that the kick the can down the road will actually last longer. And so I need to have that as my base case in the portfolio. So what I do is I'm invested for about 70% of my wealth in global stocks. And why do I do that? Stocks are basically a claim on future cash flows, right? So you make money on stocks if those future cash flows actually come to fruition, and if the valuations that on these future cash flows go up as well. Now, the kick the can down the road wants to make these earnings come to fruition because the world has to keep on growing, remember. Yes, via leverage, it's not sustainable long-term, but it actually has to happen in the kick the can down the road scenario. And as we have to make real interest rates lower and lower and lower to make the new borrowing cheaper, then also the valuation of these cash flows will go up over time. And so that has to be the bulk of my portfolio. But stocks also, of course, carry large risks in the other two scenarios, which are the upfront deleveraging scenario and the monetary reset scenario. So how do you protect that? Despite those being tail risks, then you assign a lesser percentage of your portfolio to these protecting items, but you have to. And I protect myself basically with gold, with real estate, especially the one that serves a purpose to basic human needs. So I'm talking about shelter, I'm talking about farmland, I'm talking about assets that cannot be printed. They have a scarce inherent value as well. Mm-hmm. Not just the scarcity value, but an inherent value for basic human needs. And I also own 2% of my wealth in digital assets. That's because I think there is a non-0% probability that digital assets might play a role in a monetary reset. So who am I to own zero? It's as simple as that, right? I mean, you have to think in probabilities here because nobody knows what the future will be. And so gold and the real estate part of my portfolio, they serve different needs. The real estate is a real scarce asset with inherent value for humanity. So if we move to a monetary reset, however you look at it, it will own some value in that environment. And the gold part, that is really the monetary value. So I expect that if we move away from the fully elastic credit system, gold will be seen as the natural candidate or outlet to serve as the peg for the new system. Will it be the only one? I don't know. Will it be the one? I don't know. Will it be an asset that is assigned a decent probability to be playing a large role in this? Yes, I think so, because it has already served that role in the past, and it already sits on the balance sheet of all governmental institutions around the world. So, and then the digital side is also relevant because the world is becoming more digital, and the digital assets have some transferability items and features that gold, for example, struggles with a little bit. So there I own less than I own gold. We're talking about 2% in digital assets, but I think they might play a role in this environment too. So then about, let's say, 20% of my portfolio is allocated to these assets that protect me against these tail events realizing.
Excellent, Alf. Well, I think that's a good place to wrap up, as you've really tied everything up nicely with a bow there. Is there anything else you'd like to mention before we do wrap up?
Well, Tom, this has been a great interview. I want to thank you for asking super nice questions. And then if people liked what I had to say and they want to find more of my work, I write this free newsletter, which is called the Macro Compass. It's on Substack. You can just Google it, Alf, the Macro Compass. You will find it. It's free, guys. So in case you want to check it out, just go there and you will read basically the macro endgame article I discussed about and who prints money. So if you want to know more about these topics that are very important, I think, for your financial education, feel free to check my newsletter out.
Absolutely. And we'll have some of the article links and the Substack link in the show notes as well. Al, thanks so much for your time today.
Thank you, Tom. My pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance.
Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.